Welcome to Off the Record, talking real estate with Joe and Makayla. If you're interested in the Portland, Oregon real estate market and want the unvarnished inside scoop, you've come to the right place. Thanks for giving us a listen. All right. Welcome, everyone. Thanks for joining us. We are back with the Off the Record podcast. And today we have one of my favorite people in the entire world, Mr. Todd Gydesen from Vantage Mortgage Group. But before we get into it with Todd here, how are you doing, Makayla?
I'm really good, except for the fact that I'm choking on the Nespresso you just made me. But other than that, I'm dandy.
Besides that, is it tasty?
It's very good. Thank you.
Nice. You're welcome. We're all about the coffee here. I am 3 cups into it, so I'm going to stick with water for this session here. Mr. Gydesen, I know you enjoy your coffee, but only 1 cup, right?
That's right. That's right. I got a little decaf maker that I drink, and I know, yes, I am of that age where I drink decaf, yes.
We all get to that point where caffeine becomes more hurtful than helpful. So it's all good. How are you doing today, Todd?
I'm doing amazing. It's a great day. Went for a nice long walk this morning, trying to catch up on a few things. You know, good day.
Yeah. It's 3:30, which means it's almost dark, which, is the way it is these days in our neck of the woods. But I think we've got a great show today for everyone. We have been getting a ton of questions recently about mortgage, about making application, about rates, about everything to do with buying a home. People seem to have a lot of anxiety right now with what's going on in the mortgage industry. And instead of us humble realtors talking about it all the time, I thought we'd bring in a real professional, someone that lives it day in, day out, and is an absolute pro and the very best that I know, and that's Todd Gydesen at Vantage Mortgage Group. So, yeah, just a little backstory. Todd and I know each other from the University of Oregon, where we both went to school together, played football together. And how many years did you say it was, Todd? 32?
See, since 1987, 88. So what is that?
88.
That's 35.
Ooh, wow. See, Makayla?
It's longer than I've been alive.
We were besties
And we're
before
fortunate
you
to
were
have you
even.
around, yes.
Oh.
We are. This would not be happening without Makayla.
Oh, shut it.
Todd, tell us about your career and how you got into the spot you're in right now in mortgage. And I know it's been a long time, but kind of what took you there?
I got a college degree in psychology. I was a counselor at a boys' home in Beaverton. Met my wife, realized I couldn't pay for any bills on that salary, and went to work for my father-in-law. And I looked at it as an apprenticeship for business. Ended up in project management for low voltage wiring, and that wasn't going where we needed it to go. And had some kids and a house and a wife, and trying to figure out how to take the next step. And a good friend of ours, Colin Hall, brought me under his wing, trained me in the business, and from there it's just kind of been one step after another. And it's something I truly love. I really enjoy helping people, but more than that, I'm a geek about it. So it's been something that's been great. So,
well, I appreciate you joining the show and helping us get some answers to some questions that we're getting a lot. But also, are you feeling that anxiety in the marketplace right now?
Yeah, I think the biggest thing I'm feeling right now is just the overall anxiety of buyers, of sellers, of professionals in the industry, just because we don't know what, kind of this feeling about another shoe's going to drop. When is it going to drop? And the answer is I think it already has. And I think we're somewhere hopefully on the mend from here, but we'll see where it goes.
Yeah, we're kind of feeling the same thing. There's just a lot of uncertainty, and people just don't know what the right step is. And I feel like you and I have talked about this before quite a bit, is education and being able to get your arms around the unknown and feel like you have a handle on the basics of the business, I think help people, feel comfortable with making decisions and not being stuck and figuring out whether it is the best thing for them. And we always recommend people to reach out to their mortgage professional that they have a relationship. And if you don't, I highly recommend Todd. He is the best at taking a very complex situation and making it understandable and giving you options. And that's kind of what we want to do here today, is just get some questions out there and hear what your take is, and maybe hopefully help people understand a little bit about where we're at and what it means to them. Would you add anything to that?
No, I don't think so. I think we have a good list of questions here, so.
Yeah.
Dive
With
right
that,
into
let's
that.
start the grilling of
Yes.
Mr. Todd Gydesen.
We need to know the information, Todd.
Very
So
good.
the first thing that I get, when we talk to people who want to buy a home and, we ask them, okay, what is your mortgage broker saying right now? What has that conversation been? And a lot of times, I would say more often than not, don't you think, Makayla, that they haven't even spoken to their broker yet, their mortgage broker.
They get so excited to buy a home, they jump right to the realtor usually.
Right. And that is kind of a little bit backwards because you need to get the biggest piece of the puzzle in place first, which is the mortgage. And so I guess the question is, what does it take to make loan application, Todd? I mean, what does that entail and what should people be aware of?
Let's start with time. I would say that it takes about 15 to 20 minutes. I'm hard pressed to find a place that you don't go do it online right now.
Mm-hmm.
So, create a login and a password, a secure website, answer the questions. Where do you live? Where do you work? All those type of things. And generally, most of the programs, as ours is smart enough, not smart, but smart enough to say, you answered the questions this way, here's the documents we need, and gives you a portal to drag and drop PDF documents in. So it's really become a streamlined thing. It used to involve a copier about the size of your refrigerator and about 13 reams of paper and 2 hours with some person you never met before. Now it's 15 minutes, it's online, it's the comfort of your home. I think it's a pretty easy thing.
And they can do it any time of day. They can do it from the comfort of their couch and be able to get some real information back as to what are the next steps, right?
Correct. And I think that's the biggest piece to it is how quickly you can get to the answer now, right? It used to be that way back when, and we don't want to belabor people with things like back when telephone books were in use, right? But now the information is readily available and pretty quick. Something that within 24 hours you can be pre-approved and very dialed in from the time you start to the time that you actually have pre-approval and are ready to go.
What's some of the basic information that they're going to need? Probably, employment, besides that, what other things are they going to have to answer?
The old adage is cash, credit, income, and property. So where's the money coming from? How much money do you have? Income, what do you have? Is it salary? Is it self-employed? Is it hourly? Are you a contract employee? What are you? Credit, that's easily answered through a credit score, but mainly, what is your score? What's your payment history look like? How many open lines of credit? What are your payments every month look like? What are your obligations? And then the property kind of takes care of itself, but what type of property are you looking at? Single family residence, a condo, a townhouse, manufactured home, a farm? What are these things that you're looking at so that we can narrow down? From there, we can take it to the programs that exist for you, and from that, we can help you understand what's the best option for you, whatever's important to you. Most important is keeping my payment under this, or I want an interest rate under that, or I want to be able to have it paid off in this amount of time, what's important to you, then it becomes customizable once we know what the options are.
And there's a big difference between what you get approved for and what you can afford a lot of times, I'm guessing, right?
Oh, yeah. It's rare that we'll have somebody want to spend more than they can get approved for, unless there's another person in the house that for some reason can't be on the loan or doesn't want to be on the loan, and we've got more income there than we're actually showing an underwriter. Generally, we're getting people, I'm showing them numbers and saying, hey, you're approved for a $7,000 a month house payment, and they're looking at me going, that's crazy. I don't want more than $3,000. Perfect. That's what we go for. So.
Yeah.
That would be nuts.
That would be nuts. And we've talked about that a lot on our show is that conversation and making application is critical for people getting to not only what they can afford, but also what's right for them and what makes sense for their current position in life and what they're trying to accomplish and how much they're trying to save for retirement and all those type of things. Mm-hmm. What do you see? What are you hearing on some of the conversations from people as far as making application? Is there a stress and anxiety there?
People are always worried, for one, about pulling their credit and if that's going to affect their credit. And then I was actually going to ask you also if people always ask me if they have to have their current year's taxes filed and done before they apply or in order to get qualified. So I don't even know the answer to that. So if you could help talk about that, that'd be great.
Well, let's go to the credit pull question first. Having your credit pulled one time from one person in one industry, for example, for a mortgage, is not going to ding your credit score, okay? The effect would be minimal. Your credit does adjust daily based on the balances you carry, right? So if you charge up a big something on your credit card today, your credit score tomorrow will be lower based on amount used on your balance. So your credit is a living, breathing, functioning thing that continues to work, right? So, but if you go out and you go, for example, go to JCPenney and pull a credit card, talk to me, get a pull a credit report, go to the auto dealer, pull a credit, if you're going all around town and pulling a bunch of credit, it will affect your credit score. If you're doing it for one thing, like mortgage, for example, or an auto loan, for example, you can have as many pulls as you want within 14 days and it only counts as one. So when I'm telling people that are out buying and shopping and talking to different mortgage brokers, which I highly recommend that you do, I would say that get it done all within a number of days and take advantage of that minimal impact idea.
What about the tax returns?
Tax returns need to be filed by their due date. So, for example, we've got people that were on extension from April that just in October finally finished and filed. Once they are due and should have been filed, then we need a copy of them. So before we can't force you to do something you're not doing, right? So for example, April 16th, if you're making loan application, you're not in trouble if they're not filed, as long as I can show that you've got an extension. Tax returns are most useful for people with businesses that are self-employed, or they have other things such as investment properties or a farm or something like that, to where they're gaining income and there's only one way to prove it's a tax return. Government loans like FHA and VA will require it. They will require taxes.
For self-employed, do you need a profit and loss as well?
Yes, for year-to-date profit and loss. So think about it this way, that's the only way to validate your income is to what you've reported on your taxes. And by the way, all underwriters are going to go to the IRS and make sure that what you've told them is what you told the IRS. So until, for example, for this year, here we are in November, that could be that's old news from 2022 and 2021. What are you doing now? And what you're doing now isn't going to be something that we count as income. It just validates the income that came off the last 2 years. So in other words, if we're saying you've got 10 grand a month income and this year you only made 40 grand in November, we're not doing well. If you've made 120 already, we don't get to count that. We just get to say it's validating at least what we've shown for the last 2 years.
Got it.
Okay, that's helpful. Thank you. Are you ready for the next question?
As many as you want. Yeah, I'm excited. This is
Okay.
fun.
Awesome. So can you speak to the difference of the different types of loans, so conventional, FHA, and VA?
Let's start with the easy one, and that's VA. VA, you have to be a veteran in good standing with the DD 214 to be able to use the loan. It's a great loan for veterans. It's a benefit. The real benefit of it is zero down payment, and that's really the key. Think about how many people that in this day and age can afford the payment. They've got the credit to do it. They've got the desire to do it. They just don't have the down payment, right? And they don't have, they're not lucky enough to have family that is going to give them some money. Well, the VA eliminates that, right? So
That's
VA,
fantastic.
and they also don't have monthly mortgage insurance, so the payment's a little bit better. And they also don't have, they also have a slightly better interest rate than conventional, about the same as FHA. So it's a really great program. And I can't speak enough to it. And the biggest thing I have with people that I want to caution on VA is shop that mortgage around. Talk to multiple lenders. There are some people in this industry of mine that will target veterans for larger income than they make on other loans. And that sounds horrible, but it's 100% true. And it's from some of the people that you see on the internet saying that they're the veteran's friend. So I always say, get 3 quotes on a VA loan. Always do it, because otherwise you could be paying way more.
Yeah. I've seen that too, and that's a shame.
Too bad. Yeah.
FHA is, what's great about FHA is it allows for a lot of things. It allows for a 3.5% down payment, which is a smaller down payment than most programs. It allows for bankruptcy discharge 2 years ago, foreclosure discharge 3 years ago. It allows for credit scores. It doesn't even have a minimum credit score requirement. FHA does not.
Did not know that.
Yeah, I didn't.
Wow.
But there's a catch on that one, and the reason you don't know that is because generally somewhere around 580 the computer won't approve you. So really, what's the minimum score? Well, the minimum score is what you can get approved for, and generally the computer is going to be 580 to 600, somewhere in there. So,
Wow.
But FHA isn't just a first-time home buyer loan. FHA loans have a lot of flexibility. You can buy up to a fourplex with as little as 3.5% down if you're going to live in one of the units. So it does have a lot of great things for it. The bad news with FHA is, well, the good news is interest rates are slightly lower than conventional in most cases. But the bad news is there's mortgage insurance on it, and it's there for the life of the loan. So it's all 30 years, unless you refinance out of it. So even if you come in with 50% down, buying a house with an FHA loan, there's going to be mortgage insurance on it. It'll be reduced, but it's there. So that's why generally when we're looking to people and we're saying, now we're talking about conventional, which is Fannie Mae, Freddie Mac loan, okay? When comparing that versus FHA, well, FHA has a better rate. Why don't I go with FHA? Because the mortgage insurance is much more expensive than on a conventional loan. And the mortgage insurance on a conventional loan goes away after time. So generally, we measure them against each other and point it out. And we only deal in math and facts, right? So the math says this, the facts are that. That's all there is. It's not, what can I sell you today?
Am I still right in saying that if you can show 20% equity, you can get rid of that mortgage insurance?
Correct. Yeah. Yeah, so there's a process there for petitioning that mortgage insurance off. And there's some nuances to it, but, a little bit deeper on that conversation is you bought the house, you put 5% down. 2 years later, your neighbor's house sells for $100,000 more than you bought it for. You've got the equity, right?
Right.
You can call your servicer, the person you're getting the monthly bill from, and you can pay for an appraisal, have them come out, and if you have enough equity, they will remove the mortgage insurance. Within the first 5 years, they're going to want you to have 25% equity, but after that, it would be just 20% equity. So, but there's a lot of people that bought a house in 2019 that have the equity right now that are still paying mortgage insurance that really just need a little bit of advice to go petition it off.
That's great. And when it comes to VA and FHA, something that I think to be a bigger factor in our industry over the next 12, 24 months is that assumable factor. And conventional, no, you're not going to be able to assume a conventional loan. But VA and FHA are assumable. How much of that are you seeing right now?
I'm not seeing a lot of it. Yes, they're assumable. There is a process to do it. You want to handle it through the current lender of the seller, right? And you want to make sure that that is complete. But let's say, for example, they bought the house at $300,000. They owe $275 now, and now they're trying to sell it but they're trying to sell it for $500 because hey, things are worth more than when they bought it, right? The buyer has to come in with that difference, $225,000. Right. So that's generally the tripping point is that, hey, yes, my loan's assumable, but can you take over at the balance it is and bring me the difference in cash? And that seems to be the tripping point in most cases. It can be done. And by the way, you don't have to be a veteran to assume a veteran's loan. So that's another thing. Oh. Yeah. But it's one of these things that that when you're thinking about the process of doing it, you're going to have to go through a process with their lender to get it done completely. It's not just going to be a snap of a finger where you just start making their payments. There is a process.
We heard from our escrow representative not too long ago that the VA in particular is woefully understaffed for those assumable loans, and that trying to get that done right now is difficult to impossible. I'm assuming that that's going to change, so hopefully that's something that they see the opportunity and start staffing up on that. So
You would hope.
one other thing that we hear a lot is I'm saving money to buy my home right now. Really, what's the difference between 3.5% down, 5% down, and then 10, 15, and 20% down? And you've been kind enough to put together a sheet for us that I'm going to put on the screen right now. We want to look at the difference between 5% down and 15% down. There's a ton of information in here, but Todd, why don't you kind of walk us through this and then tell me when I need to scroll down here.
Sure. Well, I think the general question is if I'm going to go out and buy a $500,000 house and I have 5% down versus I have 10 or 15 or even 20. So what the question is how much more would that cost me and what does that do to my monthly payment? So if we scroll to the bottom of the screen, we can see that the monthly payment on the left, when we look at total monthly payment, $39.13. If we put in more money to the tune of, let's say, for example, go just up above from that $39.13, the next block, $36,226 cash out of pocket. So the option then would be, well, let's save more money. Well, how much more do we need to save, and what's it going to save us monthly? So you go to the right, one block into the green there, and now you've got to have $61,000. But if you go down, it really only saved you $203 a month, $203 a month. So how long does it take you to save another $25,000? Right?
Right.
And that's really the question. Going to the far right on the blue column, look, if we go to 15% down, we had to save more to get to 86 grand, and the payment is less than $400 a month difference, a car payment basically.
Right.
So some thoughts that we're always coming to, and then go to the far right. That's 20% down. You'll see that there is not mortgage insurance in that one. So the mortgage insurance has gone away. So a couple of fears to alleviate here in this part of the conversation. Mortgage insurance, if you take a look just at our payment, any one of those columns, go up one. For example, in the left column is $83 a month.
Mm-hmm.
It's not $300 a month. It's not something scary, right?
Right.
The question starts to become, with the appreciation of houses over the last 5 years, are you better off to get in for what you have in pocket, right?
Mm-hmm.
Absorb, maybe sell a car, get out of a payment or two, right?
Right.
Absorb a little bit higher payment, come in with less cash to close, and let that appreciation at 6, 10, whatever percent a year that is, work for you. And then a couple years down the road, end up in an equity position to get that mortgage insurance off of there.
This is great information, Todd, because I think there's a lot of fear out there that, I should be putting 10% or 20% down, and we're saving towards that because we want a much smaller payment, and that's what we're supposed to do. I just don't feel like that makes financial sense all of the time. And there's certain situations, sure, of course. But I think when you look at the numbers this way on a regular purchase of $500,000, it's so interesting to see for, that $50,000 extra you're going to get to try to get to 15% down, or, $80,000 down additional over that 5% to save $600 a month. It's $6,000-$7,000 a year, but that's a lot of money to try to push towards a 20% down payment that doesn't really save you a whole heck of a lot more money. Would you agree?
Well, yeah, and you've got to ask yourself the question. So I'm going to wait and save another 25 grand. Okay.
Mm-hmm.
That means if I want to do this a year from now, I'm saving $2,000 a month, which is a lot to save a month, right? For most people, especially first-time home buyers. So we're going to wait a year from now, okay? And we're going to save our money. We don't know what rates will be then, hopefully better than they are today, but we don't know. And the answer starts to reshape itself. Well, what if, let's measure it this way. I wait and save versus I get in this house with 5% down, and let's just say something remedial like 3% appreciation on that house of $500,000.
Right.
3% appreciation, the value of that house 5 years from now is $580,000.
Right.
So you waited and saved $2,000 a month, and you're very aggressive about it, right?
Right.
So now you got 120 grand for over 5 years, right?
Right.
Whereas you could have just gotten in and made 80. So in other words, you're really only 40 grand above where you would have been if you would have just jumped in.
Right.
Right. So
There's
I'm not
also
saying to take a payment you're not comfortable. Be very comfortable with the payment.
Sure.
But get in as early as possible, because that appreciation range that train's not slowing down.
No.
Even at 3%.
That conversation becomes even more interesting when you start factoring in rental rates and what you're paying for rent right now versus what you're getting over, that 2, 3, 5 year haul for just being in a rental situation.
Yeah, and then we got some human psychology there with am I really going to save $2,000 a month? Is that money really going to be there when I need it? Am I, right? So
Right.
there's a lot of questions that go around that. Again, what we're not saying is we're not telling people to get in over their head.
Right.
And that's not what we're trying to do. What we're trying to say is, especially when things slow down a little bit like they have just right now for just a second, how do we structure this in a way where we get some seller participation on your rate, make the payment, where you want it to be, get you in for the money that you're comfortable with the monthly nut that you're comfortable with, in the neighborhood that you're comfortable living in, and then let that appreciation work for you.
How often do you sit down with people in that worksheet and they look at you and go, well, why would I put 15% down? Yeah, we want to go 5% and save our cash.
Happened yesterday.
Because I mean, to me,
I think this is going to be my new advice. This is crazy.
yeah.
Good information for people to
Yeah.
compare.
And Todd's been kind enough to allow us to put this on the website. So, everyone that's listening, LivPortland.com, click on our podcast button on our website and go to our or go to this episode, and you'll be able to see that sheet and really get a closer look at what Todd is talking about there, because I think this is a ton of great information.
Okay, Todd, let's pretend like I am coming to you as a new home buyer, and I am asking you what I should do in order to prepare to buy a home this spring.
Which we're hearing a lot right now.
I think the answer is gather information. Get as much information as possible. Educate yourself. This is a complex transaction we're about ready to go into, and I think one of the multiple things I share with you two is that the more you can educate yourself, the more comfortable you're going to be with that decision that you've made, the better you're going to be, the happier you're going to be with that decision. So I would get some great information. I would sit down with some people, maybe even get face-to-face, and let's start exploring how does mortgage works. Why are you suggesting this program over that program? Really, one of the questions that I always encourage people is to their lender, who do you work for? Are you working for the bank, or are you working for me, right?
Right.
Who's the person that's most important in this equation? And the answer is the borrower. So, if you get the feeling that it's other than that, it's time to go find a new lender.
Right.
So,
and can you
it
define
doesn't matter.
Explain to everyone what the difference between mortgage broker and maybe a bank lender? Just the quick kind of difference between the two.
So, and again, none of these situations are perfect, but I could say this. Where I'm most comfortable is being an independent mortgage broker, where I have 40 different lenders to choose from, and I'm able to go to one versus the other for my clients' needs, right?
So find what the best package is for them.
Exactly. And if that answer is that you need to go see this person down the road and I don't get paid today, that's what it is, right?
Right.
Because that's why they were sent to me in the first place, was for that guidance. When you work for the bank is, and the bank could be a bank where you go checking, get auto loans and everything else, or your credit union, or they could be a non-bank lender, but somebody that funds their own loans. Now you're in a situation where you're being given a price for that bank for that day, versus, hey, that bank's out of price a little bit today, let's go look at these other four for the very same loan.
Right.
I think it's a fiduciary responsibility that you're looking for, is my opinion. And I think you get a better bang for your buck, and hopefully a better understanding. But again, I think going back to the original question, what would I be doing? I'd be educating myself, be getting some numbers, I'd be formulating my team, I'd be very comfortable in my lender, my insurance person, my realtor, and wanting them all to be on the same team and working forwards for my best interest, right?
Got it.
I would want to get, and I think from there, it's not too easy to look at your credit initially. Look at your income. Make sure that where the cash to close is coming from is acceptable, or is there another way that we need to structure this? With that time, can we improve your credit? Are you getting a raise? Are you what are the things that are coming that are going to put you in the best position when you pull the trigger?
Right.
Got it. It seems like now's a good time to be really realistic about things in case you do need to save a few more thousand. By the spring you have some time.
But I think the conversation we just had around, that sheet that Todd was showing was, it's not all about the money. It's not all about, I'm going to buy in the spring, so I need to save X amount of money. Now, granted, you have to have a down payment and have some reserves and that type of stuff, but the equation is complicated, but not so much that you can't find the best solution for you if you don't start having the conversation and start getting your team together to figure out exactly what best fits you, right?
Right. And the other piece is also there's some programs out there to look at. Now, some of these are hard to chase down, right? But if you're buying within the city of Portland, there are funds from Portland Housing Bureau, PHB, for people that are under a certain income limit, that are going to buy in a certain area. There are some funds there that might be able to help you with down payment assistance or things like that. If you go out this weekend and you look and knock on the door of a house and that's the house you buy, you've missed out on all of that opportunity to better yourself up front. So I like both ways, but given my druthers, I'd start talking to somebody in December about a house I'm going to buy in March.
Yeah. Absolutely. We'll have that Portland Housing Bureau information on our website as well, LivPortland.com, because I think that's something that a lot of people would be interested in finding out more about.
Yeah, good info. So going back to interest rates a little bit, what would be your best advice for managing interest rates moving forward?
My best advice is that we're in a highly volatile market right now. We don't know where things are going. I think if anything that we learned over COVID was we don't know what's coming next, right? And that's not necessarily a bad thing. In that case it was, but there's some good things coming down the road for us too. I think that interest rates are going to get better once we get this inflation bug under control. Unfortunately, we're going to probably have to go into some level of recession to get there. So my advice to people is get the house you want at a payment you can afford right now, because when we get to the point of interest rates are down, they're not making any more houses right now, or at least not fast enough. That inventory is going to go back to a gobble up situation like we had during COVID, where you got 10, 20, 30 people bidding on the same house. So you've got the devil in one hand and another devil in the other. Do I want to pay a high interest rate now and refinance it later, or do I want to get a lower interest rate later when everybody else is keen on the idea and pay $100,000 more for the house, right?
The other side of it too, though, is, I mean, we talked to all these people that weren't able to get into a house over the last couple of years because of inventory, competition, everything. And yes, the interest rate is higher right now, but if you can make that happen in a way that makes sense for you, you'll be ahead of the curve and be the person that's sitting in the house. And let's say you have to sell. Once that demand comes back, what do you think is going to happen with values? Values are going to skyrocket again. It's going to happen. And it's just the way that the cycle happens in our housing industry. And being in a house and being a homeowner versus being on the outside looking in, I think would be a much better situation than trying to just time a market because of interest rate, don't you think?
I agree with that. And then think about buying that. Now you're the beneficiary of that appreciation.
Right,
You
exactly.
bought and you own the house, you're looking to refinance the mortgage versus you're looking to buy the house and pay the premium, right?
Right.
There are also other things that I think people need to keep in mind, that there's allowable seller credits in when you can negotiate with a seller. You can get things. You can get your closing costs paid for. You can get a 2-1 buy down. You can get a permanent discount point. You could, in effect, have the seller pay for, like the way I'm talking about it right now is, interest rates are 7.5%. If you buy the house with that number, you're looking at 6.5% when your first refinance opportunity comes up, right? Well,
Right.
if you got the seller paying you down to 6.5, he just paid for your first refinance, right?
Right.
Now you're looking for 5.5 for a real opportunity to refinance down the road. So how are we using leverage with that seller now that the market isn't quite as hot to benefit you in a way that makes it more affordable and makes you more comfortable?
I feel like that's a whole nother podcast in itself.
Yeah,
You know?
we've touched on it a little
Yeah,
bit,
maybe.
but
We have, yeah, but I mean, the strategy that's around that right now because of the current marketplace is so fascinating to me.
well, it's hard to explain that to someone who's kind of thinking about maybe buying, but it's easier to explain to someone who's in the weeds already and hopefully having these conversations. But
Absolutely.
just so much confusion. Wow.
Yeah.
So, I had a last question that, I kind of put out there kind of to rib Makayla a little bit, but both Todd and I played at Oregon, and Makayla went to Oregon State. And I asked, do you think the Ducks will score over 100 points against the Beavers this year? And
It's honestly just rude.
it is rude.
I kind of thought
It
you.
is so incredibly rude.
I thought you put this on there just to see if I was reading my emails.
I did.
and
we
that's
both-
why I responded in 30 seconds.
I saw that. And, I have to say that I am so impressed that you read down to the bottom on that. Thank you very
I
much.
did my homework.
But also, Todd and I have talked about this in the past. And yeah, when we were at Oregon, the Civil War was pure hatred and all that. But, everyone, I get asked this all the time, Todd, and I'm sure you do too. Do you guys still just hate the Beavers or hate the Huskies or this or that? Boy, when you get older, it's all about the Northwest and Oregon, and there's a lot of love. I mean, I've got a son at Oregon State right now, right? And he's
Me too.
dating a wonderful girl at UW. And, you know, Todd's son, Brock, is my son, Aiden's roommate at Corvallis and at Oregon State. So I just said that to rib you a little bit, but I thought I'd bring it up to, you know, just spread love and peace, people. Let's let the players on the field, you know, decide those things. But there's a lot of love to go around. So I just thought I'd have that on the record
love it.
for you.
It's fine. It just makes me a little nervous to get you two talking about football on air because I might get booted out of this podcast and this might become a sports podcast. Just
Maybe
kidding.
not. Maybe not.
Wouldn't that be fun? I don't know that we could actually do a podcast on football, Todd. That would get so not PC. I'm just worried.
Yeah. We tried. We came up with the idea, and then I started thinking about who's going to want to hear that anyway. My wife, when I start talking about it, she leaves the room. So
Yeah, yeah.
Are you guys gonna go? Are either of you going to the Civil War?
So the last Civil War that I went to was 1994 when I was on the staff as a graduate assistant at Oregon, and we clinched the Rose Bowl at Parker Stadium. And I thought, you know, that's a good one to leave on. So I haven't been back to a Civil War game in Reeser or Autzen since '94, but I'm going this year because it might be the last one. Yeah.
That's so exciting.
Todd, you've got other plans. You've got a son playing football right now who's kicking a large amount of ass. You got something for us?
He's doing well. They're playing well at College of Idaho, and we're going to be watching them in the playoffs. Hopefully, they get an opportunity to go deep.
Yeah.
Which will, has precluded me from being able to be anywhere near Oregon or Oregon State for any football game. So,
Yeah.
but I do like watching them when I can on TV, and I've got a long-standing tradition of watching the Civil War on TV because it does not rain inside my house. And so,
You're so lucky.
yeah, I've been at a couple of those where I didn't know if I was going to drown or not. So.
Yeah, they tend to be wet, nasty affairs. But, well, anyways, I wanted to thank you for coming on the show and spreading the knowledge and the information that you have. I think this has been great information, and we really appreciate it, don't we, Makayla?
Yeah. Thank you for your time, Todd.
Thank you for having me. And again, it's always a pleasure.
Thanks for joining us today. If you're interested in finding out more about Joe, myself, or the LivPortland team, you can go to livportland.com. Thanks for giving us a listen, and see you next time on the Off the Record podcast.